This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So with property income, you'll find that the rules for property income are exactly the same as they are for individuals. And there is a chapter on property income which you need to have watched and read and practiced before you come to this, because we're not going to reiterate those rules here, because I'm going to assume that you've already done that. So property income for companies on an accruals basis. So what rent has accrued with allowable deductions, and the assessable amount on a lease premium is exactly the same as it is for individuals. Now, interest payable on a loan to buy rental property is fully deductible against interest income, not property income, under the non-trade loan relationship rules. The restriction that applies to individuals does not apply to companies. There's no renter room relief. If they make a loss on the properties, it must be set off in full against total profits before QCDs in the current period. Any unused donations paid are then wasted. Excess property loss is carried forward and set against total profits. Okay. Partial claims may be made to preserve those donations. So it's against total profits and not just property income. So we've talked one or two times, you've heard me mention these non-trade loan relationship rules. This is the information on there. So all interest receivable is assessed as interest income on an accruals basis. Now it will be received gross. Interest payable, so that's different from receivable. Those two are the receivables. This is the payable. Deducted against tax adjusted profits. If it's for trade purposes, leave it where it is. Okay. If you see the word non-trade or property, okay, then you deduct it from interest income. So you add it back in the trade profits and then you deduct it. It is an allowable expense, but you deduct it from the interest income. QCDs are basically charitable donations that have been paid, and you always make the gross payment, not like individuals who make net payments. Dividends. Dividends from UK and overseas companies are exempt from corporation tax and never included in TTP. We only use dividends to calculate augmented profits. They are not taxable. So we have a fuller example here of Westmoreland, which has the following income and outgoings for the year ended 31st of March. We have trade adjusted profit, so that's already been done for us. We have property income, interest receivable, gains, capital losses, dividends, and QCDs. What is the TTP for the year? All right, let's have a look at that. Let's see if we've got some spare paper there. Yeah, we have. Okay, so it's the corporation tax computation for the year ended 31st of March 2024. So we have two columns that we need. So we're going to do tax adjusted profits. That's been done for us. You may have to do that in the exam and bring it down to this point. £1,456,500. We had property income of £25,000. We had interest receivable of £10,000. And gains. Now, gains are always net off against each other. any capital losses are only against capital gains. So we have a gain in the year of 37,500 and a loss in the year of 2,500, which gives us net gains of 35,000. So you can see that we've added them all together, listed them all. Oh, that's the end of the page. Less the QCDs of 10,000, giving us TTP, and that's what the question asked for. It didn't ask for the tax, it asked for the TTP. And there you have it. That could be a multiple choice question where you're given figures and then you need to just work out the TTP. Exam technique. Rules for CT significantly changed for Finance Act 23. Especially if you're resitting, be fully aware of the changes and the new format as shown in all the illustrations.